This is a gold spot price chart for the 21st century. The yellow line is the Fiat Federal Reserve note denominated fluctuating price for gold. The black line is an ongoing average of 163 other full fiat currency spot prices for gold, also measured from the year 2000 to now in 2020. On a technical basis, these 163 full fiat currencies gold price have broken out here in 2020. You can see how all these fiat currencies combined devalued to gold following their 2003 breakout. A similar pattern is likely to repeat this decade and perhaps into the next. The world's largest fiat currencies by FX trading, aside from the Fiat Federal Reserve note, are already hitting new record gold price highs. Here is the Fiat Euro pricing for gold. There you can see a recent breakout above the 1,400 mark in the top right corner of your screen. This is the Fiat Japanese yen pricing of gold this century. Their gold price breakout occurred late last year in 2019 and has now become support for their yen-denominated gold price. The fully fiat British pound has eclipsed its old 2011 high and appears to be moving higher here onwards. The Fiat Aussie and Canadian dollar prices are both screaming higher, respectively. When one understands how our fully fiat monetary system functions on an ever-expanding basis, it's not really a question of if, but really when we will see coming new record prices for gold and Fiat Federal Reserve notes. Hello there, this is James Anderson on behalf of sdbullion.com. The head of the chartered yet private Federal Reserve Central Bank visited the U.S. Senate and the U.S. Congress this past week. We sat through many hours of mostly meaningless testimony to bring you these highlights as Federal Reserve Chairman Jerome Powell essentially tells the world that QE forever is the new normal policy to fight recessions. And now that we've boxed in ourselves into a low-growth, over-indebted, interest rates can never go above real inflation rates again environment. Have a listen.
Both the Fed through lower rates and Congress through increased spending, through increased debt, have been taking actions to boost the economy during a long stretch of growth. I am concerned that if we do approach a downturn, and there are a number of indicators out there that are concerning to me, that our options to address a downturn are limited. I want to hear your perspective on what the Fed has as ability to react to an economic downturn, the tools.
Thank you. So our traditional tool, of course, is interest rates, and low rates are not really a choice anymore. They are a fact of reality, and they're likely to remain in, so we will have less room to cut. That means it's much more likely that we'll have to turn to the tools that we used in the financial crisis when we hit the lower bound.
Which is?
Which is forward guidance, which says it will keep rates low, and then it's also large-scale asset purchases of longer-term securities to drive longer-term rates down and support the economy. We will use those tools. I believe we will use them aggressively, should the need arise to do so. There's no need to do that now, but we will use those tools aggressively.
This is the precise moment when Montana Senator John Tester could have followed up questioning Jerome Powell about current market interventions at never-before-seen sizes and scopes. For example, the New York Federal Reserve's ongoing repo operations since mid-September last year make the last version look like child's play. This chart basically makes it look as if we're having an economic 9/11 every business day now. The Federal Reserve is expanding their balance sheet at rates not seen since the 2008 financial crisis, and on a 12-month rolling basis, this supposed greatest economy ever appears to be requiring liquidity injections from the private central bank at rates of change never before recorded in this full fiat Federal Reserve note era.
The debt's at $23 trillion right now? Isn't that about right? Something like that?
Yes.
At what point in time do you get concerned? I mean, I think the budget the president just put out is another $1 trillion to the debt.
It's very hard to say at what level you get concerned. I would say I'm be concerned now at it's really the rate of increase is what we need to do is have the debt grow slower than the economy is growing. If the economy is growing faster than the debt, then effectively leverage is going down. So debt to GDP won't be. What's happening is debt to GDP is going up and going up fairly quickly as these things move. Other countries have managed to get to very high levels, much more than ours. But what it means is that 20 years from now, we'll be spending those tax dollars, our children will be spending those tax dollars on servicing the debt rather than on the things that they really need.
Right.
We're sending them those bills.
And the debt doesn't go down if the economy downturns.
No, not at all. Quite the opposite.
Exactly right. It becomes much bigger of an issue.
This week, the New York Fed reported that U.S. household debt has been stretched again to a new all-time high. We are now many trillion beyond the 2008 housing bubble's debt peaks. Embedded within that orange trough of debt, the bigger-than-ever auto loan bubble is showing further signs of dysfunction. 3 months or more delinquency on payments is now about 50% higher than it was in the last financial bubble burst. It's hard to say how much more we can lever this one out. The fiat paper values for private financial assets are now more leveraged than ever, measured by our nation's gross domestic product. This chart illustrates that ever since the first internet stock bubble burst about 2 decades ago, the private Federal Reserve has been assisting the further financialization of our seemingly endless bubble-to-bubble economy. Breaking financial news today shows that the Federal Reserve's likely doubling of its balance sheet in the coming years will not be enough to help prop up this dangerous everything but gold and commodities price bubble that they have enabled. It appears the Federal Reserve is going to try and elicit help from mom-and-pop retail investors, providing tax incentives so that they can invest, buy, and hold stock valuations as they inevitably fall back to reality from their current record price levels. How's the old saying go? I'm from the government and I'm here to help you buy into record price stock valuations? Good luck for those who hold the S&P 500 in the coming years, for you will likely see a reversal of purchasing power measured in gold. If history is any guide moving forward, like the rollover we witnessed from the 1960s Nifty 50 era, as current majority stock market share-owning baby boomers sell off their stocks into retirement this decade and into the next, those holding falling valuation S&P 500 shares will likely see their wealth measured in gold fall by a factor of 10 or more from today. If you have winnings in the stock market, now might be a good time to be taking some of those chips off the table and moving them into prudent bullion positions. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.